All right, everybody, we have a significant Canadian company that reported earnings on Tuesday. They reported after market on Tuesday, and that is CN Rail. And one of the main things I like about CN Rail is the fact that it is a bellwether for the Canadian economy and even to an extent the US economy, but not as much. This is a company that is going to give you a really good indication as to how well the economy is doing just over, when we're talking about shipping volumes, cost to ship, and just overall demand for the services. And railways are companies that are extremely economically sensitive, I would say. During economic drawdowns, they're going to be extremely cyclical. They're not going to be in as strong of demand. And for that reason, CN Rail has struggled over the last while, and just judging by the results this quarter, which, don't get me wrong, they weren't like results that were way out of left field poor, but ultimately the results are not good from a growth perspective, and that's just nothing really the company can do. It's just the state of the economy. So I figured I would dig into the quarterly report today, give my insights on the railways, because I do really feel they are strong companies, and just overall, get some commentary on the health of the Canadian economy and whether or not CN Rail, provides pretty strong value in terms of, whether the company is at the bottom of a cyclical downtrend. As always, everybody, there is a link in the description below to join our No BS newsletter. It also includes research on 3 options that I really like in 2024. They are stocks that are highlighted over at Stock Trades Premium, and you can get them absolutely free in the description. And you'll also get our Sunday email issuances where we talk the markets, we talk market strategies, stock earnings, case studies, important news, things like that. It is a excellent newsletter once a week. It adds huge value and will help you become a better investor. But let's get right into the video. When we look to the quarter, I first want to look at estimates to give you an idea that although the quarter is weak on a year-over-year basis and the stock really hasn't done all that much over the last few years, it was still relatively inline quarter. I mean, we see earnings per share of $1.72 per share. Analysts were expecting around $1.69, so that is a beat on earnings. And we have revenue of $4.11 billion, and they were expecting $4.08 billion. So that is, relatively in line. Very small beats on both revenue and earnings. And if we actually dig into the quarter, we can see that overall earnings per share is up $1.72. So that's up 2% versus 2023. But one thing I do actually want to note here, if we go to CN Rail's shares outstanding, you're going to see that they have been buying back shares at a reasonable pace over the last year. I mean, when we look to 1-year buybacks, we're talking 647 million a year ago today to 628 million. So when you think of this, obviously buying back shares reduces the overall share count, which in turn will increase earnings per share. So although earnings are going up, this is primarily due to share buybacks. If share buybacks, if shares outstanding were still at 647 million, we would see a overall decline in earnings per share. I'm not necessarily saying this is a bad thing. This is a company that has been very shareholder friendly over the years and buys back shares at strategic times. I would say this is most certainly a strategic time because the stock is in a bit of a rut. That earnings per share growth is primarily driven through buybacks. When we look to Q3 operating income, it's pretty much flat, which once I get into the, actual volumes of their, particular amounts of shipments, you're going to understand why. And when we look to the operating ratio, this is a very important ratio for railways. And what you might notice is that, it's plus 110 basis points, which would be plus, 1.1%. And it's got a red arrow upwards. That is because operating ratios, the lower, the better. So what an operating ratio effectively does is it takes the company's operating expenses and it compares it to its overall sales. So effectively, the easiest way to explain this is what this is saying, what an operating ratio of 63.1% is saying, is that CN Rail has to spend $63.10 to generate $100 in revenue. So you'll see it is kind of the inverse of operating margin. And when we look to the company's operating margin, we can see that it sits around 40%. So this is, it's pretty close to that. There's a little bit of intricacies involved in that ratio that doesn't make it the identical inverse, but you've got a 60% operating ratio. You can expect operating margins to be somewhere in the, 37 to 40% range. So obviously one of the big things over the last quarter for CN Rail was that work stoppage, the strikes, those are all dealt with. And, to an extent, the Jasper wildfires, those really impacted the company's ability to deliver margin expansion and is likely why this operating ratio ticked up. So if we go down to the guidance, so they are reaffirming adjusted diluted earnings per share growth in the low single digit range. This is going to be, again, it's going to be primarily through share buybacks. I would imagine the company is going to continue buying back shares aggressively over the next year or so, and that is ultimately going to boost that earnings per share where operations are really not that strong. So capital expenditures on track with guidance, and returns on invested capital will be in the range of 13 to 15%. If we look to historical returns on invested capital, we can see they're at around 13.8%. So these are actually ticking upwards, which is a very good sign. They are planning for 7% dividend growth and an adjusted debt to adjusted EBITDA target of 2.5x. I haven't actually looked into what they're adjusting out here. And overall, despite a pretty rough environment, the company is doing pretty well. And what I want to do is actually look over the company's particular segments when it comes to revenue. And you're going to see year over year, there's just a decline in overall demand. I mean, if we look to petroleum and chemical revenue, we can see that, if we look to year over year numbers, we can see that this area of the business is growing. I mean, we have $758 million in revenue in September of 2023. Fast forward to September of 2024, it's grown to $839 million. But we do see 4 consecutive quarters of decline, and this is likely due to lower oil demand. There's less infrastructure spending right now, which is ultimately going to hit this end of the market relatively hard as well. So we're seeing that, 4 consecutive quarters of decline. It's not really all that surprising. When we tick that off and we look to metals and minerals revenue, again, that is, declining both on a year-over-year basis, and this is its 3rd straight quarter of declines on a quarter-over-quarter basis. And if we look to the actual report, they do mention for metals and minerals, it was because of an early seasonal slowdown in frac sand and softer market demand for metals and minerals. So they kind of explain each particular segment in here in terms of, how they're operating. When we go to the forestry products, again, we're seeing, small year-over-year growth, effectively flat. I mean, $1 million in revenue. And this actually did tick up this year. It's been ticking up for, 3 straight quarters, but they posted quite a big decline. And what the company states this is from is just weaker lumber demand. I mean, and this makes perfect sense. I mean, there's not as much, housing demand right now with higher interest rates. There's not as much houses being built. Housing starts are slowing down. This is a prime example of a weak economy, and it's really not all that surprising. When we go to the grain and fertilizer revenue, this is one segment of the business that is doing quite well. I mean, we see $722 million a year ago today to $786, and there's a large drop off, but this is relatively seasonal for the company. It will post high grain and fertilizer revenues at the latter half of the year. This is a very common situation for this type of commodity. If we look to the automotive sector, this is actually one of the biggest probably cyclical elements of the shipping industry. And what is happening right now is a lot of automobile dealerships, a lot of automobile producers, they have a ton of inventory. They have a ton of inventory that's not selling right now. Interest rates are crazy high. People are still not financing new vehicles. They're pinching pennies. They just don't have money for vehicles, period. And I mean, look at this huge increase in automobile revenue during the COVID-19 pandemic when everybody had boatloads of cash to spare. I mean, we're talking about automotive revenue from June 2021 to June 2022 increasing by 50%, more than 50%. We're seeing a pretty sharp decline in year over year. September 2023, 237 million. September 2024, 217 million. So that is seeing a big decline. And again, the company says, a lot of this is due to plant retooling, but I would say it's more so to this rising dealer inventories. I mean, dealers are just not looking to ship cars right now. I remember during the COVID-19 pandemic, the dealership lots were virtually empty. If you wanted to buy a vehicle, you needed to buy the absolute top level vehicle. That was partially because of a bit of a semiconductor shortage, but for the most part, it was just due to the huge demand in automotive, purchases, whereas right now it's just not really something that's anywhere near the top of people's minds. And as a result, it's, seeing quite a big hit from that. We're looking to intermodal revenue. I mean, this is actually a pretty big growth avenue for the company. So what intermodal revenue is effectively they get shipped by train, then the containers get taken off, put onto a truck, shipped, something like that. And you're going to get a lot of, consumer demand that is going to have an impact on this. Again, we look to the COVID-19 pandemic, we see a big increase in revenue, and now it's just kind of been perpetually on decline over the last while. I mean, we peaked at 1.3 billion in revenue in September 2022. What happened in September 2022? Interest rates started rising, and as a result, we're sitting on pretty big declines in this. I would expect this to pick up when the economy picks up, when interest rates start to come down, disposable cash starts to go up. I mean, there's more global trade volume demand overall. This should start to increase and probably return to one of the faster growing elements of the business. But as I go through every single segment here, we're noticing one trend. As the economy continues to get weaker, we're seeing declining volumes and declining demand. The main thing here is it's relatively easy to see a path forward for CN Rail. In the situation where interest rates start to decline, people start to spend money again, the economy picks back up again, infrastructure spending starts picking up again, corporations begin to be a little more willing to spend money because, debt is cheaper, financing is cheaper, and things like that, and that should cause a boost in demand. So, in terms of valuation, I know a ton of people are probably wondering whether CN Rail, I believe CN Rail is a buy right now, and I would say, in my opinion, yes. I do like CP Rail a bit more just because of the Kansas City acquisition. I do believe it's going to fuel more growth for the company moving forward, but that said, CN Rail is looking relatively cheap here when we look on a valuation basis, especially when we look to historical valuations. Again, I don't use price to earnings ratios all that much because in reality, the market truly cares about forward earnings. What I do like to look at is trailing price to earnings ratios relative to historical valuations because it can give us a pretty good idea of what the market has typically been willing to pay for this company over a 3-year, 5-year, 10-year, 15-year basis. And when we look to 5-year median averages, we're looking at 21.3x earnings, whereas, right now they're trading at 18x. So this is a double-digit discount to 5-year averages. Now, the one thing I will say is that 5-year averages have a lot of pandemic valuations in there where the economy was very, very good. There was a lot of surplus cash, a lot of discretionary spend. So for the most part, I would probably look to this 10-year median average more, the 20.1x earnings, and that still does signal a near double-digit discount to historical averages. And when we look to the price to free cash flow, 27.35, this is what many would believe to be a relatively expensive price to free cash flow ratio. But the thing about the railways, they are often very expensive because their business overall is practically impenetrable. I mean, the competition is non-existent. Just the infrastructure spending you would need to actually build out a railway, it's nearly impossible. So these companies just are dominant, and as a result, investors typically end up paying much more for them. That's a double-digit discount as well to 10-year median averages. I mean, we're talking 29.56x, and it's trading now at 27.35. So again, double-digit discounts to historical averages across the board. When we look to PE ratios versus Canadian Pacific, it is much cheaper. We're looking at 18x earnings versus Canadian Pacific 29. I do believe that has a lot to do with the Kansas City acquisition. I mean, Canadian Pacific is expected to grow a lot faster than CN Rail moving forward just because of that acquisition. But again, that doesn't make CN Rail a poor option. I mean, they're better debt structured now. CP had to take out a bunch of debt for that acquisition. So there is more growth priced into CP, but I would imagine there's, a lot more things that can go wrong for CP, whereas CN Rail just seems like a relatively safe bargain play right now. When we look on a price to free cash flow basis, again, we're looking at, CP is trading at double the price to free cash flow ratio. I would imagine there's a lot of acquisition costs and stuff that is impacting CP's price to free cash flow and price to earnings on a trailing basis. So these valuations are likely not as wide, but there's little to no mistake about it right now. CN Rail is cheaper than CP. When we look to the final thing I'll talk about is the forward estimates. they are expected to post relatively flat earnings on a year-over-year basis. We're looking at, they earned $7.28 last year, $7.37 this year. When we jump forward to 2025, we're looking at, this would be probably high single-digit growth expected for the railway moving forward, and then, high single-digit growth moving forward in 2026. I would imagine these estimates are going to vary wildly depending on, how policymakers navigate the economy, how bad it gets, things like that. So these are probably prone to change quite a bit. So if this PEG ratio of 1.2x, that would indicate that the market is pricing in a lot of growth for CN Rail moving forward. But if the economy gets better, I would imagine that these earnings estimates are ticked upwards. And I do believe that there's value here for CN Rail. They're a 25 plus year dividend growth streak company. Cash flows have been very, very strong moving forward. Overall, I do feel that the railways are going to be an opportunity as the economy gets weaker. It could get weaker than this. If you were looking to add a position into a railway right now, it would be very easy to dollar cost average over the next 12 months, 18 months until the economy improves. Maybe this is the bottom here, and dollar cost averaging ends up costing you some money because you're paying more in the future. But it's a relatively risk averse way of averaging into a cyclical company in case things do get bad. I expect CN Rail to buy back, continue buying back a bunch of shares because its shares are discounted from a historical basis. They obviously know this. They've been very, they've executed dividend growth and buyback plans very well in the future, and I have no doubt they'll continue to do so in the future. So everybody, if you like this video, head down below, like the video, subscribe to the channel, and comment down below what company you want me to look over next, and stay tuned for more great investing content.